Gold just crossed $5,000. Silver swung 30% in a single week. And the largest financial institutions on Earth are saying absolutely nothing. Not a warning, not an explanation, not even a mention. While central banks quietly purchased 863 tons, while record billions flooded into ETFs, while the Treasury market, $30 trillion deep, started showing cracks, the silence became deafening. Three structural forces are converging. Forces that haven't aligned in over 50 years. And if you're holding cash, building a business, or planning for the next decade, what's being hidden from you right now could redefine everything you thought you understood about money itself. The question isn't whether this matters. The question is, why is no one telling you? Welcome to John Analyst, where we don't follow the narrative, we follow the numbers. Now, before we go any further, if you've been watching financial markets long enough to remember when information wasn't free, when analysis required more than a headline, do me a favor, hit that subscribe button. Think of it as bookmarking the one place that won't waste your time with noise, and drop a comment below. Tell me where you're watching from. New York, London, Mumbai, São Paulo. I want to know where the serious thinkers are paying attention, because what we're about to break down doesn't care about borders. Let's begin. There is a rule in financial markets that rarely gets spoken aloud, but governs almost everything. When something moves violently, the explanations come immediately. Stocks crash, analysts flood the airwaves, currencies collapse, emergency reports get published, banks fail, congressional hearings get scheduled. The speed of the explanation is proportional to the size of the disruption. That is the rule. And right now, that rule is being broken. Gold has risen over 60% in the past year. Silver has surged more than 150% over the same period. In recent weeks, silver moved from the low 70s to above $90 per ounce, then crashed back down, then recovered, all within days. Gold approached $5,000 per ounce, a psychological threshold that would have dominated headlines a decade ago. The gold to silver ratio, a metric watched by every serious metals trader, swung violently into the mid-50s. And yet, the coverage has been almost non-existent. No primetime financial segments dedicated to the move. No front-page analysis in major business publications. No emergency analyst calls from the largest investment banks. The silence is not subtle. It is structural. Flip through the major financial networks. And the focus remains locked on equity indices, technology stocks, artificial intelligence valuations, cryptocurrency speculation, precious metals. Despite exhibiting the kind of volatility typically reserved for distressed assets or emerging market currencies, have been relegated to the commodity section, treated as a curiosity, a niche interest, something for the preppers and the pessimists. But here is what makes this silence strange. The entities moving these markets are not retail speculators, they are central banks. They are sovereign wealth funds, they are institutional money managers, controlling billions in assets under management. In 2025, central banks purchased 863 tons of gold. That is not a small number. That is sustained, deliberate, strategic accumulation. At the same time, global gold ETFs recorded their strongest year of inflows on record. Assets under management hit all-time highs. Average daily trading volume in gold markets reached the equivalent of hundreds of billions of dollars. These are not the signatures of speculative froth. These are the signatures of institutional repositioning. And yet, the analytical community has remained remarkably quiet. Why? The answer lies in what this move represents. Gold and silver are not behaving like commodities. They are behaving like systemic stress indicators. And when systemic stress indicators start flashing, and the instinct of the financial establishment is not to amplify the signal, it is to manage the narrative. Because if the general public begins to understand what institutional players are quietly doing, the repricing accelerates. And acceleration creates instability. So instead, the volatility gets explained away. Silver is just being silver. Gold always does this during uncertainty. It's a flight to safety. Nothing has fundamentally changed. These explanations are not technically wrong. They are incomplete. And incompleteness, in moments like this, is functionally identical to deception. Consider the divergence between gold and silver over the past month. Gold has exhibited relative stability. Yes, it has moved, but it has moved with a certain compositional calm. It dipped after certain headlines, recovered after others, but it never entered full chaos mode. Silver, on the other hand, has been erratic. It has swung like a pendulum in a hurricane. One day up 5%, the next day down 8%, the day after that up 7%. This divergence is telling a story. Gold is being accumulated by entities that think in decades. Silver is being traded by entities that think in minutes. Gold is behaving like a mature, safe haven asset. Silver is behaving like a hybrid. part monetary metal, part industrial commodity, part speculative vehicle. And this creates a problem for anyone trying to understand what is actually happening, because the surface narrative says metals are volatile because markets are uncertain. But the structural reality says metals are volatile because three independent forces are colliding simultaneously. Liquidity infrastructure is fracturing, industrial demand is transforming, monetary system architecture is fragmenting. Each of these forces, on its own, would create friction. Together, they create the conditions for a sustained repricing event, not a bubble, not a speculative mania, a repricing. And repricing events do not announce themselves with fireworks and ticker tape parades. They happen quietly, in the background, while the majority of participants are focused elsewhere. This is a story about the financial system sending a signal that most people are not equipped to interpret. The question is not whether gold and silver matter. The question is, why is no one with a major platform willing to say out loud what the data is screaming? And the answer to that question is where this story begins. There's a term used in professional trading circles that most people never hear: liquidity illusion. It refers to the dangerous assumption that because a market appears liquid under normal conditions, it will remain liquid under stress. History has a habit of punishing this assumption, and right now, that punishment is being administered across multiple markets simultaneously. Most people believe the U.S. Treasury market is unshakable. It is the deepest, most liquid market on the planet. $30 trillion in marketable debt outstanding, traded around the clock, backed by the full faith and credit of the United States government. If any market should function smoothly, it is this one. And yet, economists and dealers are now openly tracking liquidity metrics in the Treasury market with the kind of intensity usually reserved for distressed emerging market bonds. Bid-ask spreads, the gap between what buyers are willing to pay and what sellers are willing to accept, have been widening. Market depth, the ability to execute large orders without moving the price significantly, has been shrinking. Price impact, the degree to which a single transaction disrupts the market, has been increasing. These are not theoretical concerns. These are measurable deteriorations in the plumbing of the global financial system. And here is why this matters for gold and silver. If the largest, safest, most liquid market in the world is showing stress fractures, what do you think is happening in markets 1/10 the size? Silver's entire market capitalization is a rounding error compared to the Treasury market. And when liquidity evaporates in small markets, the consequences are not linear, they are exponential. Consider what happened in recent weeks. Silver moved from the low 70s to above $90, then crashed back into the 80s, all within a span of days. The explanations offered were predictable. It's the overnight session. It's just how silver trades. Leverage got fleshed out. All true, all insufficient. Because the real question is not what happened. The real question is, why did it happen with such violence? The answer lies in positioning. The futures market for silver has been carrying open interest above 400,000 contracts. Each contract represents 5,000 ounces. Do the math. That is over 2 billion ounces of paper silver being held in speculative positions. Now compare that to annual global mine production, roughly 800 million ounces. The paper market is trading multiples of the physical supply that actually exists. This creates a structure that is inherently unstable. When everyone is leaning the same direction and liquidity suddenly thins, even a small catalyst can trigger a cascade. It is not a match causing an explosion. It is a match landing in a room already filled with gasoline fumes. The gasoline was the positioning. The match was the headline. And when the fire started, there was nowhere to run. Because liquidity, the ability to exit a position without destroying your own price, had already vanished. This is not unique to silver. It is happening across asset classes. Look at the currency markets. The dollar-yen exchange rate recently hit approximately 157 yen per dollar. That level represents extreme stress. It represents years of policy divergence compressed into a single price. And when that price starts to unwind, it does not unwind gently. Carry trades, strategies that borrow in low interest rate currencies and invest in high interest rate currencies, begin to collapse. Hedge funds start deleveraging. Risk parity funds start rebalancing. And all of that forced selling hits the market at the same time. The result? Volatility spikes across every asset class connected to those trades, including precious metals. Because in moments of stress, correlation goes to 1. Everything sells off together, not because the fundamentals changed, but because the liquidity disappeared. And this brings us to the most dangerous illusion of all. The belief that physical metals and paper metals are the same thing. They are not. Paper markets trade on leverage, speed, and liquidity assumptions. Physical markets trade on delivery capacity, refinery throughput, and dealer balance sheets. And right now, those two worlds are diverging. Small dealers are struggling to manage inventory during volatile periods. Why? Because when they buy physical metal from a seller, They need to hedge that position in the futures market. That hedge requires a credit line. It requires available balance sheet capacity. It requires a functioning relationship with a refinery that can process the metal and return it to deliverable form. When any of those links break, the dealer cannot offer competitive bids. So a seller walks in with a large quantity of silver, expecting near spot prices, and instead gets an offer 10% below market. The seller assumes the dealer is greedy. The dealer is not greedy. The dealer is constrained by credit, constrained by capacity, constrained by a system that was built for calm, not chaos. And when the system is constrained, prices do not reflect supply and demand. They reflect panic and positioning. This is what liquidity failure looks like. It does not announce itself with alarms. It reveals itself in executions that do not make sense, in spreads that should not exist, in markets that freeze when they should flow. And the longer this continues, the more dangerous the environment becomes. Because liquidity, once lost, does not return quickly. It requires confidence. And confidence, right now, is the one commodity in shorter supply than silver itself. There's a moment in every commodity cycle that separates the informed from the delusional. It is the moment when price and narrative collide with physical reality. And right now, that moment has arrived for silver. For decades, silver has been categorized as a precious metal, a store of value, a monetary hedge, a smaller, more volatile cousin of gold. That categorization is now obsolete. What is happening to silver is not a monetary story pretending to be an industrial story. It is an industrial transformation disguising itself as a monetary event. And the difference matters, because it changes everything about how this market will behave over the next decade. Start with the numbers that almost no one outside the industry is tracking. The photovoltaic sector, solar panel manufacturing, consumed approximately 197 million ounces of silver in a recent year. That is not a projection. That is actual reported demand. And it is rising, not because of market forces, not because solar became economically superior overnight, but because governments around the world have mandated energy transition timelines that are now locked into policy. Solar capacity expansion is no longer optional. It is legislated, subsidized, enforced, which means the demand for silver in this sector is not price sensitive in the way traditional commodity demand is price sensitive. A solar panel manufacturer does not halt production because silver hit $90 instead of $70. They pass the cost forward. They adjust their procurement strategy. They lock in supply agreements, but they do not stop building. Because stopping means missing policy deadlines. And missing policy deadlines means losing subsidies, permits, and political support. This creates a demand profile that traditional commodity analysis is not built to handle. Normally, when a commodity price rises sharply, demand falls. Substitutes get deployed, projects get delayed, the market rebalances. But in a policy-driven demand environment, price increases do not reduce demand. They ration supply. And when supply gets rationed, the entities with the longest time horizons and the deepest pockets win. Now zoom out to total silver demand. Industry research has projected global silver demand for 2025 at approximately 1.12 billion ounces. At the same time, those same reports have documented a multi-year structural supply deficit, meaning, for several consecutive years, the world has consumed more silver than it has mined. The gap has been filled by above-ground inventories, stockpiles, recycled material, strategic reserves quietly being drawn down. But here is the problem with drawing down inventories. Eventually, they run out. And when they run out, price does not adjust smoothly. It dislocates. Because the market suddenly realizes that the supply it assumed would always be available is not. This is not speculation. This is arithmetic. If demand exceeds supply for long enough, and inventories shrink to a critical threshold, the market enters a different regime, a regime where availability matters more than price, where securing supply becomes a strategic priority rather than a cost optimization problem. And this is already happening. Look at the behavior shift in major markets. In China, overall gold consumption declined in 2025, but bars and coins demand surged. It surpassed jewelry demand for the first time in decades. That is not a trivial shift. Jewelry demand is discretionary. It responds to price. When gold gets expensive, people buy less jewelry, but investment demand, bars and coins, responds to fear, to uncertainty, to the belief that holding physical metal is safer than holding financial promises. And when investment demand overtakes jewelry demand, it signals a psychological transition, a transition from luxury consumption to wealth preservation. The same dynamic is playing out in silver, but with an added layer. Because silver is not just a wealth preservation vehicle. It is a critical input in technologies that define the next industrial era. Solar panels, electric vehicles, 5G infrastructure, medical devices, defense systems. Every single one of these sectors is expanding, and every single one requires silver, not as an option, as a necessity. There is no substitute for silver in high-efficiency photovoltaic cells. There is no alternative that matches its electrical conductivity at scale. This is not a marketing claim. This is materials science. And materials science does not care about investment thesis or market sentiment. It cares about atomic structure and performance specifications. Now layer in the broader metals complex. Platinum is trading above $2,000 per ounce. Palladium is north of $1,800. These are not isolated events. These are coordinated signals that the entire tangible inputs basket is being repriced. And the repricing is being driven by something larger than speculation. It is being driven by governments realizing that supply chains are vulnerabilities, that relying on a single source for critical materials is a national security risk, that stockpiling is not wasteful, it is strategic. Defense departments are now procuring metals the way they procure munitions, not based on immediate need, based on projected conflict scenarios. Energy transition agencies are locking in supply agreements years in advance, not because they are bullish on metals, because they cannot afford to be wrong about availability. This is the industrial imperative. It is not driven by fear of currency collapse. It is driven by fear of production shutdown. And production shutdowns, in a world where supply chains are already fragile, are politically unacceptable. Which means the bid for physical metal is no longer just financial. It is geopolitical. And geopolitical demand does not respond to price corrections the way speculative demand does. It responds to availability. And availability, right now, is becoming the scarcest commodity of all. This is why silver's volatility is not noise. It is the market trying to solve an unsolvable problem. How do you price an asset that is simultaneously a financial hedge and an industrial bottleneck? The answer is violently. There is a question that central bankers will never answer honestly in public. What happens when the world stops believing? Not in a single currency, not in a single policy, but in the entire architecture of trust that holds the monetary system together. That question is no longer theoretical. It is being answered right now, in real time, in the quietest, most deliberate way possible, through gold purchases. In 2025, central banks around the world bought 863 tons of gold, not as a temporary hedge, not as a tactical position, as a permanent addition to sovereign reserves, and they did this while gold was rising, which violates every rule of traditional reserve management. Reserve managers are supposed to be cost-conscious. They are supposed to buy low and sell high. They are supposed to optimize returns within acceptable risk parameters. But that is not what is happening. Central banks are buying gold at all-time highs. They are buying it during volatility. They are buying it despite the price, because the price is irrelevant. What matters is the position, and the position they are taking is clear. They are diversifying away from a system they no longer fully trust. This is not panic, this is strategy. And strategy, executed at this scale, changes the rules of the entire game. Now look at the institutional side. In 2025, global gold ETFs recorded their strongest year of inflows on record. Assets under management hit all-time highs. Daily trading volume in gold markets averaged the equivalent of hundreds of billions of dollars. This is not retail money chasing headlines. This is institutional capital repositioning for a structural shift. Pension funds, sovereign wealth funds, family offices managing generational wealth. These entities do not move quickly. They do not chase trends. They move when they have concluded that the risk of not moving is greater than the risk of moving. And they are moving now. But here is where the narrative gets complicated. Because at the same time, gold is rising, the US dollar is also rising. Traditional analysis says this should not happen. Gold and the dollar are supposed to be inversely correlated. When one goes up, the other goes down. That relationship has broken. And the break is not a technical glitch. It is a structural message. The message is this: the world still needs dollars. Because there is no alternative reserve currency with the depth, liquidity, and legal infrastructure to replace it. But the world no longer trusts that the dollar system is permanent. So it is doing both, using dollars for transactions, holding gold for insurance. This is not contradiction. This is pragmatism. And it is creating a pricing environment that confuses everyone trained in the old correlations. Because the old correlations assumed a stable system with temporary fluctuations. What we have now is an unstable system with the appearance of stability. And unstable systems do not correct smoothly. They fragment. Look at what is driving this fragmentation. Sanctions. In the past 5 years, economic sanctions have become the primary tool of geopolitical enforcement. Assets have been frozen. Payment systems have been weaponized. Access to the dollar system has been used as leverage. And every time that happens, every country watching takes notes. They ask themselves a simple question: could this happen to us? And if the answer is yes, or even maybe, they begin building redundancy. They negotiate bilateral trade agreements that bypass the dollar. They develop alternative payment systems. They increase gold reserves, not because they want to destroy the dollar, but because they cannot afford to be completely dependent on a system that can be turned off with a political decision. This is why reserve diversification is accelerating. It is not ideological, it is risk management. And risk management, when practiced by sovereign nations, creates sustained demand that does not fluctuate with sentiment. Now add the capital markets dimension. Hong Kong's IPO market raised $37.2 billion in 2025, a record. And in early 2026, hundreds of companies are waiting in the listing pipeline. This is not a coincidence. This is financial gravity shifting. For decades, if a company wanted to raise serious capital, it went to New York or London. That is changing, not overnight, but measurably. And as capital markets grow in regions that are also the largest consumers of industrial metals, pricing power shifts, information flow shifts, market structure shifts, which means the entities setting the price for silver, for platinum, for critical minerals, are no longer exclusively Western financial institutions. They are Asian manufacturers, Asian funds, Asian exchanges, and Asian demand profiles are different. They are less financialized, more focused on physical delivery, more sensitive to supply security than price optimization. This creates a market that behaves differently under stress. And stress, right now, is the default condition. There is one more layer that ties this all together. Policy constraints. Markets are obsessed with central bank appointments. Who will be the next Fed chair? Will they be hawkish or dovish? Will they raise rates or cut rates? But these questions miss the point. Because the policy options available are narrowing. If central banks tighten aggressively, credit markets break. If they loosen aggressively, confidence erodes. Either path keeps precious metals relevant. Tightening supports the dollar, undermines growth, increases demand for safe havens. Loosening undermines currency confidence, increases demand for hard assets. The trap is structural. And the market knows it, which is why gold and silver are not trading on policy predictions. They are trading on policy impossibility, the recognition that there is no path forward that restores the old equilibrium. And when equilibrium cannot be restored, the system reorganizes around new anchors. Gold is becoming one of those anchors, not because it is perfect, but because it is outside the system. It cannot be printed, it cannot be sanctioned, it cannot be frozen, it simply exists. And in a world where trust is fragmenting, existence is enough. This is not the end of the dollar. This is the beginning of a multipolar reserve system where no single currency dominates, where gold plays a larger role, where volatility is permanent, and where the entities that understand this earliest position accordingly. The coverage gap exists because acknowledging this reality is inconvenient. It challenges assumptions. It complicates narratives. It forces uncomfortable questions about what comes next. But the data does not care about comfort, and neither does the market.